This is what Tom Lee just said about inflation and our markets today on CNBC.
5,500 number, but it doesn't necessarily reflect how you think the year is going to end. Are you going to take a look at your year-end targets now?
We are, Carl. At the early December last year, we thought S&P could reach 5,200 this year, which at the time was almost a 20% gain. We've obviously moved well above it, and the fundamental picture to me looks stronger. I think earnings next year, we originally thought would be 260 for 2025. It's probably closer to 275. I think the war on inflation has been meaningfully better in terms of progress. I know there was a lot of dispute, but I think the last two inflation reports and the fact that 55% of inflation components are back to pre-pandemic levels means inflation is really going to fall like a rock. These are factors that give us comfort that multiples can expand. And so I think 5,200 is clearly too low, but I don't know how much above 5,500 there is into year end. So I think in a couple weeks we'll be addressing that.
You actually use a graphic of a falling rock in your charts to describe elements of inflation that you think are dropping. You said we're beginning to see insurances a break, waiting for shelter to follow suit. Some of your forecast, Tom, on new cars and used cars, do you actually think we could see that kind of deflation?
Yes. I think one thing to keep in mind is that there's almost 290 million cars on the road today. So when used car prices fall 10%, and they're continuing to fall, that's a meaningful amount of disinflation and may be painful for people who've borrowed money to buy cars. But that is also saving people who are buying cars. And so I think there's a lot of goods disinflation in the pipeline, and especially with new cars, inventories have really been picking up. The CDK cyber security hack might sort of disrupt it short term because there's a shortage now of new cars available, but I think the trend for new cars is also lower.
So, Tom, what happens to earnings estimates in this environment? I mean, I get that it's good for the market if inflation falls and the Fed starts cutting rates. Maybe that trumps everything. But if the economy starts to really weaken and these forecasts for Q2 are coming down, then what about the earnings picture?
Well, it's, first of all, there's always winners and losers. There's a lot of companies in sectors that have no correlation to inflation. Technology is one example. And there's many groups highly correlated to the rate of inflation, like basic materials and energy. We're not talking about overall inflation going negative. It's actually that it's going towards 2%. So there's still plenty of companies that are getting price. And as you know, the biggest pressure on many companies' margins has been wage pressures. That's cooling a lot, and gasoline's cooling, and that's really helping consumer wallets. So I think it's pretty complex, but to us, if the global economy is picking up and earnings delivered have already suggested 270 for 2025, I still think we're maybe going to be closer to 280 next year.
Tom, if markets tend to lead the fundamentals and we've run up here, to let's say 21 times forward earnings, why would improved earnings relative to expectations now lead to multiple expansion, on top of what we've already had?
It's a fair question. It's really the composition of what contributes to the gains, because if you look at S&P forward, it is high. I think forward earnings multiple is like 19, but the median is 16. And the median PE in the Russell 2000 is actually 11 times. So I think that there are going to be many stocks that can re-rate towards 20, but the PEs many stocks that are at 27 PE, I mean, they could increase in their multiple, but I think there'll be a lot more juice in the 16 multiple going to 20 than there is 27 going to 28.
Hey, finally, Tom, 5 days in a row, S&P headline index and breadth have diverged. We haven't seen that kind of streak since the late 90s. Are we going to start assembling lists of analogs to the late 90s? And is that a good thing?
Carl, the late 90s didn't end well. So I think if this is going to look like the late 90s, then investors do have to be really preparing some portfolios that are appropriate for that. And that in the 90s, late 90s, that meant to really be patient with value. And then, of course, be ready to exit the high momentum. In some ways, I think the skepticism that exists today, because, I was an analyst starting in 93. So I saw the 90s. There was a lot more ebullience back then and a lot more people who didn't think stocks could ever go down. I think there's a lot of top callers today. So for me, this feels a lot more mid-cycle. And I know it sounds surprising, but there's just too many top callers, especially among our institutional clients.
Now, that was a very fascinating interview by Tom Lee. And one of the main points is Tom Lee still believes in this broadening out of the markets. He was basically saying that instead of your high multiple stocks just going higher and re-rating higher, you're likely to see the internals of the markets, the stocks trading at 11 or 15, 16 times, go up in multiple to see a re-rating higher. And that's where you get the alpha, the excess return, and the S&P going ahead. Overall, he sounded pretty bullish, but kind of defensive about the whole 90s comparison to then and now. The only real pushback he gave in regards to comparing this market to the dot-com bubble was the top callers that you have now among institutional investors. And the fact that Tom Lee actually offered some kind of guidance in what to do if this is a, dot-com bubble kind of situation that we're in the markets. And what he said, for anyone that did not catch it, he basically said you need to be ready to get out of your high multiple stocks, get out of your momentum stocks when that boat does ultimately sail. Now, as we have talked about many times here on the channel, the average correction during an election year is about 13%. So you do normally see a large pullback during election years. This year, you've only seen a 5% pullback. So odds are good that you do see a larger pullback at some point between now and the election itself, which is on November 6th. I think the reason for any kind of downside will be important. If Nvidia were to miss, that would be problematic. Now, Micron's earnings last night, Micron said that basically their high bandwidth memory is sold out throughout 2025 already, considering they sell that primarily to Nvidia. It begs the question of, you're probably not going to see Nvidia miss on earnings any kind of substantial way. But if overall earnings season does disappoint, then you could definitely see estimates fall, because estimates are very high today. Estimates are for 14 to 15% EPS growth this year and next year. And right now, Wall Street is not pricing in a recession. They're not pricing in much of a slowdown. And a vast majority of the actual dollar for dollar earnings is expected to come from big tech. If there's any kind of scare there, that would be problematic. Ultimately, the big crash comes if the Fed makes an error and waits too long to start cutting rates. But I think it's too early to tell on that. And here in at least the next couple of weeks, the markets will really react to inflation data. Coming tomorrow morning, we are going to get core PC price index month over month. We're expecting 0.1%. Odds are pretty good that this could actually come in at 0, if not a negative number. If that were to happen, I think the internals of the markets probably take a leg higher. It wouldn't surprise me if big tech sold off a little bit, if you started to get a rotation out of big tech into value, into areas of the markets that will benefit from lower inflation and an easier policy going ahead from the Fed. We are also going to get personal income month over month, expecting that to be 0.4%. Last month was 0.3%, so a rise there. And personal spending month over month is expected to come in at 0.3%. That's a very important data point, because over 73% of the economy's GDP is comprised of people spending money. So if that spending data does not come in good, then you're really going to be scratching your head saying, how strong is this economy after all? So that data comes out at 8:30 in the morning tomorrow. At 9:45 in the morning tomorrow, you will get Chicago PMI, expecting that around 42. Last month was 35.4, so you're expecting that to get a little bit better. And then you do have Fed Bowman that speaks at noon, and that is it for your day tomorrow. Here today, you did get couple different data points. Durable goods orders came in at 0.1%. You were expecting 0.1%. Last month's number came in at 0.2%. 0.2%, it was revised down from 0.7%. So just going off of that metric, you would have had a very negative month-over-month durable goods orders number if that last month number was not revised lower. So in fact, this was actually showing a weakening economy in the durable goods orders that came out today. Not exactly a great sign. GDP growth rate, quarter over quarter, final numbers for Q1, came in at 1.4%. 1.3% was the last number that we had. That was also the estimate. So the economy apparently did okay in Q1. We had initial jobless claims that came in at 233,000, beating the estimate, or coming in lower than the estimate, maybe I should say, of 235,000. So that was great. But continuing jobless claims did spike up yet again, as you can see from this chart. You're definitely continuing to get that upwards rise in continuing jobless claims, which has been rising really ever since the mid part of 2022. So definitely starting to get into an upward trajectory again, and something we want to be watching pretty closely here. Pending home sales were expected to come in at positive 2.3%. They came in at negative 2.1%. So that was a big miss. Pending home sales year over year were expected at negative 4.0%. You actually came in at negative 6.6%. This is some of the worst data you've seen since 2020. Kansas Fed Composite Index came in at negative 8. You were expecting positive 1, not great. Kansas Fed Manufacturing Index came in at negative 11. You were expecting positive 2. So definitely the theme today is a weakening economy. And here you can see Treasury Bond ETF TLT just saw an inflow of 2.7 billion on Monday, its largest one-day inflow in all of history. That's kind of insane, because what happens is, if you're seeing inflows to TLT, people buying TLT, that means people are betting that treasury yields are going to fall a lot. And that would suggest a weakening economy. That would suggest either that or inflation does actually fall like a rock, and easier Fed policy could be coming. The odds of your first cut coming July 31st have now moved up to 12.4% from previously yesterday being 10.3%. And we are right back to a new cycle low for equal weighted S&P 500 relative to cap weighted S&P 500, and the ratio is at the lowest since December of 2008. So equal weight really underperforming the S&P even more. Fed Bostic made some good comments today for markets. He says inflation is moving in the right direction. Interest rate cut likely in Q4. Peter Berserkin on X, he is the chief global strategist and director of research at B Cares Research, formerly with Goldman Sachs and IMF, the International Monetary Fund. He says, I hope this is a data error, but LinkUp's estimate of job openings posted by America's top 10,000 companies is crashing, like literally crashing in the last week or two. It's just straight down. And yes, the data that we got today was a new record low for US pending home sales. According to the yield curve, the probability of a recession by December 2024 is at 63%. This level has only been seen 3 times since 1960. All 3 ended in severe recessions: 1974, 1980, and 1981. Game of Trade says this time is not different. I mean, you have a higher probability now of a recession based on the yield curve than even 2007, 2008. Check this crazy prediction out from Walter Bloomberg. He's reposting a Pantheon forecast. He says inflation expected to slow lead to aggressive Fed easing. The Fed is likely to cut interest rates by 25 basis points in September, followed up with twice as big cuts in November and December. So 125 basis points of rate cuts. 5 rate cuts this year, he says. In a much more aggressive easing than 1 or 2 cuts markets expect and officials project for 2024. Pantheon economists say in a note, they argue that upcoming data will show that the Q1 acceleration was an anomaly and the disinflationary trend remains ingrained. As a result, Pantheon forecasts a strong rally in treasuries, driving the 10-year yield down to about 3.25% by the end of the year. That would be the lowest since late 2022. Today, the 10-year treasury yield is at 4.286%. That would explain all of the inflows to TLT that we've seen this week. Fed Bowman just reiterated yet again that she is still willing to raise rates again if inflation doesn't ease. And this is what makes me concerned about the Fed right now trying to navigate the economy to a soft landing and get inflation down, is they're still talking about potentially needing to raise rates. We should be talking about cutting rates to preserve the other side of the dual mandate, the maximum employment mandate that the Fed seems to have recently forgotten about. Core cap goods shipments slipped into negative year-over-year territory in May, worth keeping an eye on as we've been here before without being in recession, but a further plunge would be notable. Option activity in the S&P 500 expiring this Friday is still crazy bad. I've never seen numbers like this before. Put to call ratio versus open interest is 32.15, meaning there is 32 times more puts than calls for this Friday's expiration. Open interest on the call side is 3%. Open interest on the put side is almost 97%. Although volume today is pretty neutral, 47.5% call volume and 52.5% put volume, these numbers are just crazy bearish. I mean, you don't normally see numbers like that, not even close. For an example, just to go to a random expiration of November 15th, 2024, you do have about 32% call open interest and 68% put open interest. That is only 2 times as many puts than calls. If we look at August 16th, then you're looking at 3 times as many puts to calls. Still, I mean, given the run-up that we've seen in stocks, that's not too crazy of a number, but 32 times more puts than calls by this Friday, it really makes you wonder what the data tomorrow could look like. Sentiment for the SPY over on StockTwits today is bullish at 74, almost extremely bullish today. CNN's Fear and Greed Index is sitting at 45, which is barely neutral. The percent of stocks above their 50-day moving average is up 2.3% today. So 2.3% of stocks are actually breaking above their 50-day moving average. Currently, you're at about 40% of stocks above their 50-day moving average. So this market's still not that healthy, still doesn't look great internally, but is improving a little bit today. You still have about 60% of stocks, 60% of all stocks out there that are currently and still in a downtrend below their 50-day moving average. And based on the data today, 10-year treasury yields are down about 3 basis points. As far as the S&P 500, the key level to watch on the downside is about 535. I think 540 can be a psychological level to be watching for. And we've really just been trading sideways now for a period of time. And I do think the markets have been waiting for that PCE data coming out tomorrow. So I am expecting a bigger move to come based on that tomorrow morning. If you do get a breakout to the upside, I really think it's going to be a broader based rally. I don't think big tech is sustainable to just continue to power the markets higher. But that next big level to watch is 550 on the S&P, which would be a new all-time high. S&P as well as the NASDAQ are still overbought on the RSIs, something else to consider. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.